Welcome everyone. This is a stock analysis for Intel. This is going to be a long video. Don't expect any TikTok style BS animations and crap like that. You're going to see me for half an hour talking about business segments, talking about valuation, fundamentals. We're going to look at margins. We're going to look at strategies, past strategy, future strategy. There is a ton of things that I want to talk about, including the new CEO that was recently appointed, insider information, insider ownership. There is insider information doesn't mean that I have insider information. It means insider buying activity and much more. So I hope that you have the patience to go through some parts of this video. I don't think you're going to watch everything, so feel free to skip. And yeah, let's go into it. So this is the performance per segment. And here we can see the Intel products, which we have, clients, we have data center AI and network and edge. These are the three segments that make sense, at least from an operating income perspective, because you can see that all three are in the positive values. So we have relatively decent margins, operating margins in the client segment. Data center segment margins are coming down, not a surprise considering Intel's position in this market. And this segment is quite interesting, but it's more interesting the company's decision to move the two main parts of networking and edge to the other segments. Yeah, so we can see, I think it's going to be in Q1 this year. Yeah, Q1 this year. We're going to see networking that is going to be moved to data center AI, and edge is going to be moved to the client segment. And of course, this is part of a strategy to make these figures to look a bit better, which makes sense considering that the other segment, the Intel Foundry, well, to say that it looks bad is to be a bit kind, because you can see the operating losses in this segment are absolutely scary. And it's even scarier when you look at the capex of the company. And, most of that capex goes into this segment. So I will be honest, when the rumors came in, I think it was by the middle of February that Taiwan Semiconductor was interested, maybe in a joint venture, maybe in, acquiring this part of the company. Of course, you have the CHIPS Act, which doesn't allow Intel to sell more than 50% of their ownership in the foundry. That's part of the deal. And I believe there was like 7.9 billion in fundings from the CHIPS Act, and maybe 3 billion more from manufacturing contracts. So a significant amount of money that Intel got to develop the foundries. So yeah, I was quite excited by then. But of course, those were rumors. And then when people from the board, you will see that in a moment because I'm going to go through the press release. But when people from the board actually declined that those conversations ever happened, and they said, "Oh no, we're not interested in that," that's when I lost a bit my confidence in Intel. Because if Intel was mainly focused here, amazing. The company will make sense, and I will probably buy shares in the company. But the foundry business, I believe they overestimated the demand that they will have from third-party companies. Of course, they have more capacity than what they need for their own products. And of course, this is creating a significant drag in the company. So overall, I have a chart where you can see the 4 business segments. You can see the operating income of these 4 segments per year. Yeah, so 2024, this is crazy. We have negative 13.4 billion operating loss in the Intel Foundry segment. And that's significantly more than, what the company made from the client segment, from, networking and edge, and from data center and AI. So you can see here clearly since 2021, since that IDM 2.0 strategy, I think I have it here, that was designed by the previous CEO. Since this strategy came into place, I don't know. I just don't really understand why the company is doubling down on Foundry. I believe it's because they want to keep the x86 architecture. I believe that's why they are doubling down, because as soon as they give up the Foundries, x86 is gone. Now, does it make sense to keep that? I don't know. I really don't know. To me, it doesn't make much. It doesn't make much sense. All right. So in any case, yeah, this was the reason why the company is struggling. Yeah. So just to be clear, is this segment is dragging the company down, and at the same time, data center AI is also losing quite a lot of, I wouldn't say traction, but you can see the decline over the past years. It's quite significant. Client, I'm not really worried because the number of PCs, the number of PCs sold, I think it decreased since 2022. I think it peaked in 2022, and since then it went down. So I'm not really worried about the client segment. What makes me worried, number one, is the Intel Foundry, and then the data center AI. These are the two segments that I want to see a big change before I can change my view on Intel. Great. Let's move on now to a very quick valuation. Don't worry, we're going to go through more details in a moment. But looking from a valuation perspective, we have the price to earnings ratio. It's negative. It makes sense if we look at the income statement. We scroll down, we can see the net income negative 18.7 billion in the year. That's a lot. That's like the equivalent to the net gain they had in 2021. So essentially the company has mirrored, the horizontal axis, and now things are just going down. That said, this loss is mainly due to non-cash, not mainly, but non-cash factors, non-cash expenses. They accounted to this loss. So you can see that, income tax expense was up significantly, 8 billion. And that's because the company initially thought that they could allocate 9.9 billion as a non-cash tax expense against US deferred tax assets. What the hell does that mean? Essentially, it means that they thought they would save 10 billion in taxes, and they didn't because of their losses over the past 3 years. And now they have to pay taxes, and you can see here the actual value, which is big. So this was, if we don't take into account taxes, the loss is negative 11 billion, still a lot. If we scroll up, we can see two big contributors to the loss, which is goodwill. Finally, we had an impairment in goodwill. I will explain in a moment why. And we have merger and restructuring charges. I think there was 15,000 or 12,000. I'm not sure if it was 15% of the workforce or 15,000 employees that got laid off last year. I always get mixed about these two figures. Significant changes, and restructuring changes, and you can see that in the trend since 22. This has been persistent. So I'm not surprised to see that. Goodwill, if we go to the balance sheet, goodwill, I'm quite dissatisfied by the fact that we haven't seen a goodwill write down earlier, maybe in 2023 to be specific. Back in 22, we already saw results that, just look at the stock price, 2021 April, and then bam, goes down by the mid-end of 2022. How much was the decline? Was it a 50%? Back 65% decline, and goodwill was still kept, in the balance sheet. It was constant in 22, let alone 23. So finally, goodwill, this non-cash expense is cooling off, which again, I'm not sure, out of these 24.7 billion, I'm not sure how much is legit goodwill, because I don't know. If you tell me that this value is this much for a company that is truly valuable from a perspective in, for example, data center AI or in the CPUs, maybe yes, but I don't know. I just to be honest, I don't feel comfortable seeing this value, and I believe it's going to be coming down maybe to the 20 billion. I believe that could be a bit more reasonable. So if things don't improve, I believe this could come down in the next years, which will of course impact net income. Moving on. So yeah, price to earnings. That was my point. My point was, even if we look at operating income, things are not looking fine. Yeah. That said, operating income is negative, which is bad, and you probably understand why it's bad because we've seen before the chart. Where was the chart again? Here, you can see that the Intel Foundry has tracked down that operating income. Even though that was the case, if we go and have a look at the cash flow statement, it seems that operating cash flow is positive, 8 billion. So the company hasn't actually burned cash in operations last year. Of course, they generated significantly less than in 2020, significantly. But that doesn't mean that the company is burning money from an operations perspective. What is going on, and this is one of the reasons why I don't really like the company, is because of the capex. Capex is negative 24 billion. Negative 24 billion. And of course, if you have capex negative 24 and operating cash flow is 8, free cash flow, it's going to be depressed. I mean, just look at this. Since 22, free cash flows have been in the negative range. So that's not really encouraging when you look at, price to free cash flow. You cannot even use it because the company doesn't have free cash flow. So yeah, right. Moving on. Apart from price to free cash flow and price to earnings, which we can't really use to evaluate the company, the things that we do have are EV to sales. So how much you're paying for the company if you wanted to acquire it, relative to how much the company is making per year in revenues. So Intel looks cheap. Yeah, it's cheap. It's cheap, to be honest. 2.5 times. That's a reasonable value. NVIDIA is about 20.3. That's crazy because they made about 130 billion, I think it was last year. And, paying 20 times that to acquire the company, it's quite a good chunk of money. Samsung, so by the way, the reason I choose those competitors is because, of course, Taiwan Semiconductors and Samsung are direct competitors in the foundry segment, and the remaining two are the main competitors in the other segments. So, in this Intel products. So mainly computer, data center AI, and NX. All right. So EV to sales, yeah, it's cheap. It's cheap. I wouldn't say it's overvalued. When we look at the price to book value again, it looks reasonable, and it looks reasonable even despite the goodwill write down. So that write down that we've seen before, was it about 3 billion? So if we have a look at the income statement, the write down in goodwill, it was about 3 billion. So despite that, the price to book ratio looks quite attractive when you look at this. So you're paying for the company's book value, for the share price. Sorry, it's book value, which looks cheap. Don't get me wrong. And from an operating cash flow perspective, it also looks cheap. Samsung, it's of course, but Samsung, the reason why it's cheaper than Intel is because it's in South Korea. I don't know how many investors they really have what it takes to invest in a ticker like this one. You can probably understand why this company is trading quite cheaply, even though it has over 200 billion in sales in the past year. So yeah, that's my conclusion with the valuation analysis, is that on an EV to sales and price to book basis, it makes sense. I believe Intel is fairly valued at the very least and cheap at the very best. However, you have to look at the narrative, and if the narrative made sense, then I believe these valuation ratios would be justified. And then you will say, perfect, the valuation ratio looks cheap, the narrative is fine, I'm buying. Great. That's not the case, unfortunately. So the narrative doesn't look well. And if I go to the next slides, particularly if I look at the outlook, things are not really encouraging. So we have Q1 25, we have GAAP gross margins. This is what the company expects in terms of gross margins, 34%. Whereas we have the Q1 2024 actuals. It was 41%. So this was a year ago. So you can see a significant decline in these GAAP gross margins. I have here a chart to see the actual values. This is the overall gross margin for the year, and the gross profit margin. And you can see the decline. Since 2017, 2018, things have been declining. And 2022 with that IDM 2.0, that's the moment when the company started to turn really south. And that's where you see these depressed margins. It's almost half of what you had in 2018. And as I said before, that's because of the of the strategy of the company, that IDM 2.0, where I understand why this was put in place back then. Is because the company expected significantly more external customers, other foundries, than what actually was realized. And their plan was to spend a lot of money in new foundries, doubling down on the foundry segment, and that didn't turn out to be the right decision. I mean, of course, you say this in retrospective, but yeah, I wouldn't say that back then it was that obvious. So that said, their plan back then was about $20 billion to build 2 new fabs in Arizona. That investment was actually a bit more than that, $28 billion for these 2. I think it was Fab 52 and 62. And the thing is that those foundries, they got delayed. So not only they're more expensive than what they initially thought back then, but they got delayed significantly by half a decade. I mean, come on. We have 2024, end of 2024, I believe here it is. It was the timeline to complete these foundries. Yeah, so Fab 52, mass production, it was aimed by the end of 24, and Fab 62 mass production was soon after, so around 2025. And it didn't happen. And now the new plan is to have that mass production by the end of 2031 and 2032. I mean, that's not particularly good news. It's good news now from a capital allocation strategy, because that means the company is going to hopefully burn less. And you can see in the guidance, one of the things I didn't discuss is that the guidance on the next page includes capex to be about 20 billion. And if I go back to the cash flow statement, capex, very quickly, where is it? I'm sure it's somewhere and I'm not able to see it. There it is. So capex was negative 24. Yeah, so 24 billion spent, 24, yeah, spent, which was a little bit better than 23 and in line with 22. So this value is going to be 20 billion next year. That's what the company projects. So something to keep an eye on. So this, probably the reason why there is an improvement is because of these delays that were announced in March, which again, I believe they're good news. And when it comes to those labs, those 2 labs, they were part of their construction was funded by the CHIPS Act, by the previous administration CHIPS Act. So Intel landed about 8 billion from this act, another 3 billion from I think this was a manufacturing contract from the Biden-Harris administration. So that's about 11 billion in total. And yet, with all that money, they had to push back the plans. And that's not really good. Now, another thing that is not good is the 18A. Well, I wouldn't say it's not good because it's already ready. So according to their website, if I go here, the 18A process node is ready. And it's prepared for the tape outs in the first half of 2025. The problem is that there was an article. Let's see if I find it. It's not easy to find these things when you have 30 tabs open. I'm really sorry. I believe it was this article. So NVIDIA and Broadcom, they were testing chips on Intel manufacturing process on that 18A. And the issue yeah, if I go here and I have a summary, is that the Foundry unit is facing delays, pushing back the full availability of the 18A process for external customers. Again, not internal, not Intel, but this will be NVIDIA's or will be Broadcom's. And that's going to be pushed back for mid 2026 due to issues with qualifying the IP of several components. Mid 2026, it's quite far away from today. And this could have been a great catalyst, signing clients for the 18A process, which I still believe, at the very least, I still believe NVIDIA is going to sign a contract with Intel. At the very least, I believe so. But I'm not sure if other companies like Broadcom, maybe, AMD, probably not. And who knows if other players will join. But yeah, mid 26 to start mass production, it's quite late in this case. But that's according to this article. Anyways, let's move back to my point. So coming back to the CHIPS Act, the issue that I see is not the 18A per se, but it's with the Panther Lake, which the company said that it's going to be ready for the second half of 2025. Great. There were rumors that it's not going to be ready until next year, and there was a slide deck. So this is a slide deck from Intel. In China, there was an event in China, and some of this text, this is translated into English. And what happens is that you see the product roadmap and the Panther Lake. You see the projected timeline for the Panther Lake is Q1 26. It's not the second half of 25. So I don't know. This could be a hint that maybe it's going to happen at the back end of the year, maybe moving into Q1 26. And, I wouldn't be surprised to see this delay. Again, it's not a major thing. I wouldn't say the Panther Lake is the product that is going to turn around the company and make things, different. I think it's just another, chip like the previous ones. And I don't know. The only positive thing is that it has the 18A manufacturing process, and it would be a really good product to see how effective this process is. So something to keep an eye on is what's happening with the Panther Lake this year. So moving on, as I said, the 18A process node manufacturing is ready. So they can already build on that 1.8 nanometer architecture. And again, that means that the smallest components in the chip is about 18 Armstrongs or 1.8 nanometers. And usually, the smaller those components are, usually these are transistors, the more you can fit in a chip, which means the more processing you can make and the more efficient it becomes. So 18A, great, it's ready. You have the tape outs in H125. So keep an eye on in the earnings call to see, in the next earnings call to see what's the feedback from this. And just as a back story on the 18A, we have the 20As. I don't know if you heard about them. Probably not. Last year, they were canceled. And was it people or was it the CEO? I don't really know who said that, but they said that 20As were canceled mainly because they were kind of like an intermediate process to the 18As. And they said, okay, there's no reason to spend money on this if you're going to go straight to the 18As, and they got rid of the 20As. Great, but what's not great is that the Arrow Lake, which was supposed to run on the 28 process, big chance, again, this is not confirmed, but there is a big chance that it's running on TMSC, Taiwan Semiconductor's manufacturing process. So this is an issue because if you have an Intel product that is being manufactured with your competitor, number one competitor process, whilst you have foundries, that's not really positive, at least not in my view. Now, moving on to the narrative, so far, I don't really see any positive things. I mean, maybe I overlooked something, so please let me know in the comments. I can be wrong. As I will be honest, this is one of the most complex companies I've ever analyzed. Usually, I analyze anywhere between 100 to 200 equities per year. by far, Intel has been the most difficult one with a significant difference because of the story of the company and how complex the semiconductor environment is. So moving on, the next the next headwind comes from the Trump administration. I really don't think he's going to push Congress to end the CHIPS Act. So as I already said before, Intel secured a significant amount from this from the funding, and I really don't think that Congress is going to go and say, actually, we're not going to give you more money for the manufacturing of the foundries. So yeah, the positive thing, moving on to a little bit more exciting things, there was a rumor mid-February from Bayard, however you pronounce that, and that was a rumor that Taiwan Semiconductors was interested in the Foundry business, particularly in a spin-off. And back then, mid-February 2025, we had the best weekly advance in over 25 years. So if I look here at the charts, that was the week, and you can see the stock price going up by 24%, which was not bad at all. So, of course, that came, and I believe the market was really excited about that rumor. It came from the rumor that this Foundry segment is out. It turns out that the rumor was not correct. So if you look at, there was more. Reuters doubled down on the rumor, and they said, "Oh yeah, Taiwan Semiconductors, they pitched the joint foundry with, NVIDIA, AMD, Broadcom." That was another rumor that doubled down on the previous one that Bayard, or however you pronounce this, started. But it turns out that was not correct. So one of the members from Taiwan Semiconductors, they actually said that they never discussed anything with in regards to the foundry business. And just a few days later, you have this guy coming up and saying that, yeah, Taiwan Semiconductors has never been in touch with me in regards to this. And then, focusing on the part that they actually are interested in Intel's packaging services. And, the thing is, to be really honest, NVIDIA, in this article, they say that they plan to invest $500 billion over the next 4 years. Yeah, so that's a significant amount of money, and that they want to invest it, of course, in their global procurement. And about 100 billion of this, or something in the range of hundreds of billions, are going to go to the US manufacturing. So maybe that could be an opportunity for Intel to gain some contracts with NVIDIA, particularly for the gaming segment, which again is not a data center segment, it's not to manufacture chips that end up in GPUs, which that will be an announcement that could absolutely move the share price positively. So until that happens, yeah, I remain a bit skeptic about Intel. Now, are these rumors? Probably yes, probably these are other rumors, even more. NVIDIA and Broadcom, they're testing chips, trying to understand what's going on with those 18As. And and I think the main points from this, is the deals that Intel already has with Microsoft and Amazon. But the problem is that they haven't disclosed the scope or the volumes of those agreements for the moment. So even though Intel already has some customers for the 18A process node manufacturing, the problem is that we don't know the size of that. And just a few months, half a year ago, we had Intel that had a setback because Broadcom tested the 14A architecture, and the results were not, the 18A architecture, and the results were not particularly attractive. That said, if this article is correct, Broadcom hasn't really left out Intel, so they're still trying to understand, what's going on with the 18As. All right, so we got the new CEO. Great news. Of course, the stock market was quite excited about it. Just take into account that in his previous tenure, the guy turned the company to from 2009 to 2021. That's a 38 bagger if you had shares in Cadence. Again, I don't know how you pronounce it. Cadence Design Systems. That was the company where he was the CEO for this period of time. So 38x, not bad at all. That's a proper turnaround. And yeah, there are cultural changes. So far, I haven't seen anything concrete, to be honest. Yes, cultural changes is good. He's planning to get rid of that middle management to make the company a startup type of company, which is great. That's the foundations for a turnaround is to get rid of all the bureaucracy and all that conflicts from middle management to change. And in regards to the share ownership, the problem that I see is, well, it's not a problem, to be honest, because of the size of the company, but no one in the board and no executive officers, they have a share ownership above 1%. And of course, the company is huge, so it's difficult to have that big of a stake in the company. But usually I like to see insider buying, insider incentives in the company. And, even the CEO doesn't really have that big of a position. When you compare it to someone else, like, the old CEO, for example. In any case, they're going to get granted. So he's going to get these grants, the stock-based compensation. And of course, that could go up. In any case, if we look at insider trading activity, we have the old CEO buying a lot last year. But I don't like this because he was alone in that. So nobody was buying with him. And when I look at insider buying activity, what I want to look for is a cluster of insider buying. So several people buying at the same time, particularly after a sell-off. That's the signal that indicates me that, okay, management and the board and everyone is happy and confident in a turnaround. And so far, I'm just seeing the CEO buying this. I don't know. It's not compelling. Now, the last 2 points is finally the sale of the memory segment to SK Hynix. Of course, this is the biggest, I believe NVIDIA was the biggest client that they had in the memory segment for their GPUs. So this is not something new because the sale was already agreed in 2021. And, well, now it was completed finally. So 2 billion more, to spend on CapEx or burn in operations. But, well, as I said before, the company doesn't burn money in operations. They burn money on a GAAP basis in the income statement, but not in the cash flow statement. So, to finalize, I think the most important part of this video is going to be to keep an eye on this conference, the Direct Connect 2025. So that's on April 29. And that's where theoretically the CEO will give more information on what's going on with the Foundry business. And so far we haven't seen anything about, what specifically on what's going to be the plan. And this is probably a good opportunity to understand what's going on. Good. So, to be honest, the summary from this is I really don't have a lot of confidence in Intel at the moment because there is no concrete plan on what's going to happen with the Foundry segment. So far, I believe the management plans to keep the Foundry business within the company. They don't plan to spin it off or divest it. And if that's the case, I believe we're going to see high CapEx moving forward in the range of 20 billion, 15 to 20 billion, if you look at the next 5 years. And at the same time, this segment is not profitable because the company needs to sign big customers like NVIDIA, Broadcom, or anyone else. And those customers, they have already contracts with Taiwan Semiconductors, and they're quite comfortable, I believe, with this customer. And unless there are, headwinds in China from, a possible invasion in Taiwan, who knows? It's unpredictable. Unless that happens, Intel's foundry business is going to stay a bit depressed, in my opinion. And if I was to look at the investment that Huang mentioned, the hundreds of billions or maybe 100 billion in the US supply chain, maybe part of that is going to go to Intel, and specifically for that gaming segment, for the NVIDIA's gaming segment, not for the GPUs in the data center segment. So overall, I believe the thesis on Intel is a thesis on their foundry, and until they sort this segment, I believe the stock is going to be depressed because the segment is dragging down the company in terms of profitability, in terms of free cash flows, and in terms of investor sentiment. So that's it. Thank you for watching this video, which I do agree that it was quite long, and I hope to see you in the next one.